Most people believe turning into thousand begins with finding the perfect trade. That belief is why most traders stay small. Not because they lack intelligence, not because they lack effort, but because they are looking in the wrong place. They search for entries when they should be studying behavior. They chase setups when they should be learning patience. They focus on money when they should be focused on process. And that raises a hard question. What if the real edge was never the trade itself? What if it was the mind behind the trade? A small account does not become a large account through luck. It becomes larger through survival, then discipline, then select aggression. In that order, miss that sequence, and capital disappears before skill ever has a chance to mature. Look closely at how beginners behave. They feel pressure to act. $10 feels small, so they think small money must be traded aggressively to become meaningful. They overtrade. They force opportunities. They take weak setups because inactivity feels like failure. Have you noticed that? The strange discomfort of waiting? That feeling has emptied more accounts than bad analysis ever has. The market does not reward action. It rewards correct action. There is a difference, and that difference is everything. A trader who turns 10 into $30,000 is rarely the busiest person in the market. Often he is the quietest. He watches longer. He acts less. But when the moment is clear, he acts decisively. Why? Because observation comes first. Before money grows, perception must grow. You begin by watching how price behaves around important levels. Not drawing endless lines. Not covering charts and indicators. Just watching. Does price reject sharply or drift weakly? Does volume rise when price breaks, or does it fade? Does a move continue with strength, or stall immediately after excitement? These small details are not small at all. They are footprints. They reveal conviction, hesitation, fear, greed, the hidden emotions driving price. And markets are moved by emotion long before logic catches up. Think about that. When price suddenly rises, what happens inside most traders? Excitement, urgency, fear of missing out. They buy because others are buying. Not because they understand what they are seeing, because leads to effect. Emotion clouds judgment. Clouded judgment creates poor entries. Poor entries create stress. Stress creates impulsive exits. Impulsive exits create losses. Losses create revenge trading, and the cycle repeats. So how does 10 become 1,000? By breaking that cycle early. You stop reacting emotionally. You start interpreting behavior objectively. That means asking better questions. Not, can this go up? Ask, who is trapped here? Not, should I enter now? I'll ask, is momentum expanding or exhausting? Not, how much can I make? Ask, what is the risk if I am wrong? Do you see the shift? The weak trader thinks about profit first. The skilled trader thinks about position first. That changes everything, because protecting capital creates staying power. Staying power creates experience. Experience sharpens judgment. Sharper judgment improves execution. Better execution compounds capital. Again, cause and effect. This is how growth actually happens. Now here is something few understand. The jump from 10 to 100 is psychologically harder than the jump from 100 to 1,000. Why? Because at the beginning, every gain feels insignificant, and every loss feels personal. Small traders become impatient precisely because the numbers seem too small to matter. But habits formed in small money become destiny in larger money. If you gamble with 10, you will gamble with 1,000. If you chase candles with N10, you will chase candles with a 10,000. Size does not improve character. It magnifies it. So the small account is not a limitation. It is a mirror. What is it showing you? Are you disciplined, or are you restless? Are you selective, or are you impulsive? Can you sit through boredom, or do you need constant stimulation? Trading quietly asks these questions every day, and most people answer without realizing it. Practically speaking, what should you look for? Look for clean movement, strong direction, clear structure, compression followed by expansion, repeated defense of a level, failed breakouts that reveal weakness, sudden reversals with force that signal trapped participants. But equally important, know what to avoid. Avoid random chop. Avoid trading in emotional exhaustion. Avoid entering because a candle looks strong without context. Avoid oversized positions that make clear thinking impossible. And avoid the deadliest mistake of all, changing your method after every loss. Would you dig 10 shallow wells looking for water, or one deep well? Trading is no different. Depth wins. Study one setup deeply. Learn its rhythm. Learn when it works. Learn when it fails. Learn what volume looks like before expansion. Learn what weakness feels like before reversal. Mastery is repetition with awareness. Then comes the next layer, scaling. Not bigger because you feel confident. Bigger because your edge has been demonstrated repeatedly. Confidence based on emotion is dangerous. Confidence based on evidence is powerful. There is a quiet authority that develops when you know what you are looking at. No excitement. No panic. Just clarity. That calmness is worth more than strategy, because the market constantly tests temperament. A sudden drop. Do you freeze? A breakout? Do you chase? A loss? Do you revenge trade? Or do you remain still, measured, clear? That stillness is strength. Jesse Livermore understood something timeless. Markets change their clothing, but human nature underneath stays remarkably similar. Fear still rushes exits. Greed still chases tops. Hope still holds losers too long. Pride still refuses to cut loss. And if human nature repeats, behavior repeats. If behavior repeats, opportunity repeats. Now ask yourself, if opportunity repeats, why do most fail repeatedly? Because they see price, but not behavior. They see movement, but not motive. They see candles, but not psychology. And once you begin seeing motive beneath movement, once you begin recognizing when crowds are euphoric, when they are fearful, when they are trapped, when smart money is patient while noise becomes loud, that is when 10 stops being just 10. It becomes capital directed by judgment. Most traders make a dangerous mistake the moment they begin with small money. They treat it casually. $10 feels disposable. $20 feels insignificant. $100 feels too small to deserve serious respect. And because it feels small, they trade it carelessly. They take reckless entries. They ignore risk. They chase quick moves. They gamble, hoping small money can somehow be forced into becoming big money overnight. But tell me, if a man cannot handle $10 with discipline, what makes him believe he will handle 1,000 any differently? Money does not change habits, it exposes them. Small capital is where discipline is built, or where bad instincts become permanent. Every careless trade leaves a mark on the mind. Every impulsive decision teaches the brain that emotional action is acceptable. Every oversized position creates attachment, fear, and panic. These patterns become muscle memory. Then one day more capital arrives. The trader thinks bigger money will solve everything. He believes larger size will create larger success. But he brings the same impatience, the same weak risk control, the same emotional decisions, and now those flaws carry heavier consequences. This is why serious discipline must begin when the stakes are small, not later. Now, treat small capital like professional capital. Before entering a trade, ask yourself why this setup. What confirms it? Where is risk invalidated? What behavior is price showing? Is this movement clean, or is it noise dressed up as opportunity? These questions sharpen judgment, and judgment is what grows accounts. Not excitement, not speed, not constant action. Have you noticed how beginners always feel the need to be involved? If price moves, they feel they must catch it. If they miss a move, they feel behind. If they sit out, they feel unproductive. But markets reward selectivity, not activity. The trader with small capital must understand this faster than anyone else, because every unnecessary trade is a tax on survival, and survival matters. A small account cannot absorb repeated mistakes. One reckless position can cut opportunity in half. A second one creates desperation. A third pushes the trader into emotional decision-making. Once emotion leads, discipline disappears. Cause becomes effect. Weak discipline creates weak execution. Weak execution creates losses. Losses create frustration. Frustration creates revenge trading. Revenge trading destroys capital. The cycle is predictable because human behavior is predictable. This is why serious discipline is not just about protecting money. It is about protecting clarity. A disciplined trader is calm because risk is controlled. When risk is controlled, thinking remains sharp. When thinking remains sharp, execution improves. Better execution builds trust in your process. That trust removes emotional chaos. Then something interesting happens. Small capital starts teaching big lessons. You begin respecting timing. You stop forcing trades. You recognize when price is expanding with conviction and when it is simply moving on empty excitement. You learn that missing a trade is cheaper than forcing a bad one. You begin understanding that capital is ammunition, not decoration. And ammunition must be preserved until the target is clear. Would a skilled hunter fire at every shadow in the distance? Or would he wait until the shot is obvious? Trading is no different. Discipline is waiting without weakness. Discipline is acting without hesitation when conditions align. Discipline is staying small when uncertain. Discipline is refusing trades that do not fit your edge, even when temptation is loud. That seriousness creates a quiet advantage. Most traders cannot sit still. Most cannot think clearly when money is involved. Most cannot separate opportunity from impulse. Most traders think profit comes from action. That is where they go wrong. They believe movement demands response. They think every candle is opportunity. They feel every market swing is calling their name. So they enter too early, exit too fast, and spend most of their time reacting instead of understanding. But answer this honestly. How many bad trades were taken because you were certain, and how many were taken simply because you were tired of waiting? That question reveals more about a trader than any strategy ever will. Patience is not passive. It is active control. It is the discipline to observe without interference. The ability to let price reveal intention before committing capital. The calmness to sit through noise without convincing yourself that noise is signal. Most people cannot do this. Silence makes them uncomfortable. Waiting creates tension. Inactivity feels like missed opportunity, so they force trades. And forced trades carry a hidden cost. Not just money, clarity. When you enter out of impatience, your judgment is already compromised. You stop seeing what is happening and start seeing what you want to happen. You interpret weak momentum as strength. You ignore warning signs. You justify poor entries because emotion has already made the decision. Then the market does what it always does. It exposes impatience. A rushed entry becomes a stressful position. Stress creates attachment. Attachment creates fear. Fear creates hesitation when action is needed. Hesitation turns manageable loss into painful damage. Cause and effect. One impatient moment can trigger a chain of poor decisions. Now consider the patient trader. He does not chase price. He studies behavior. He waits for structure to become clear. He watches how price reacts at key levels. He notices whether momentum builds naturally or rises in sudden emotional bursts. He pays attention to failed breakouts, repeated rejections, tightening ranges, and expanding volume. He understands a simple truth. Good trades often feel obvious only after patience has done its work. Why rush toward uncertainty when clarity arrives to those willing to wait? The market constantly creates temptation, but not constant opportunity. There is a difference that most traders never learn. Temptation is frequent. Real opportunity is selective. Patience allows you to separate the two. Without patience, everything looks tradable. With patience, weak setups become easy to ignore, and that changes your entire relationship with trading. You stop feeling hunted by the market. You stop feeling late. You stop believing you must always be involved. You begin thinking like a decision maker, not a gambler chasing stimulation. This shift matters because profit is rarely made in random moments. It is usually made in clear moments, moments when pressure builds quietly, when behavior becomes readable, when risk can be defined, and when probability begins leaning in one direction with enough force to justify action. That takes waiting, and waiting is harder than trading. Have you noticed how boredom creates bad decisions? A quiet market makes restless traders dangerous to themselves. They invent setups. They lower standards. They convince themselves that average opportunities are exceptional. Not because the market changed, but because patience weakened. That is why patience must come before profit. Profit built without patience is usually temporary. It often comes from luck, random timing, or aggressive risk. But luck teaches nothing. Random wins create false confidence. Aggressive risk creates fragile habits. Patience builds something stronger, consistency of thought. And consistent thinking leads to consistent execution. The patient trader does not need constant action. He needs one clear reason to act. Most traders stare at charts, but very few actually read them. They watch candles rise and fall. They mark support and resistance. They memorize patterns, indicators, and signals. Yet, despite all that watching, they still miss what matters most: behavior. Price is only what happened. Behavior is why it happened. That difference separates observers from traders who truly understand markets. Ask yourself this: when a candle suddenly surges upward, what do you see? Do you only see green and think strength? Or do you ask what kind of buying created that move? Was it confident accumulation, emotional chasing, short covering, or a trap designed to pull late buyers in? The candle shows movement. Behavior reveals intention. And intention is where real information lives. Markets speak through behavior long before they speak through direction. A chart begins whispering clues before it makes obvious moves. Price may hesitate near a level several times without breaking. Volume may rise while movement becomes narrow. A breakout may happen, but follow-through may feel weak. A sharp rejection may appear exactly where confidence looked strongest. These are not random details. They are signs of pressure building, conviction fading, buyers exhausting, sellers defending, or trapped traders reacting emotionally. Every move carries a motive beneath the surface, and once you begin looking for motive instead of motion, the chart starts becoming clearer. Most traders make the mistake of reading candles in isolation. One strong candle means nothing by itself. Context means everything. A large bullish candle after steady accumulation means one thing. The same candle after a chaotic emotional drop means something completely different. One may signal real strength. The other may simply be panic reversal or temporary relief before weakness returns. Do you see why so many traders get trapped? They react to appearance without understanding behavior, and appearance is often misleading. Fast movement attracts attention. Sharp rallies create excitement. Sudden drops create fear. Emotional traders respond instantly because they believe speed means certainty. But experienced traders know aggressive movement often hides emotional imbalance, and emotional imbalance creates opportunity, but usually not where the crowd believes. When everyone sees strength, ask what is fueling it. When everyone sees weakness, ask who is trapped. When price breaks a major level, do not immediately ask where it is going. Ask how it is breaking. Is volume supporting the move? Is follow-through clean? Does price hold above the breakout level, or does it quickly slip back? Is momentum expanding naturally, or is it bursting in a way that feels desperate? Behavior answers what candles cannot. This is where observation becomes skill. You begin noticing repeated rejection at key zones. You notice false breakouts that pull traders in before reversing sharply. You notice quiet consolidations where price tightens and pressure builds beneath the surface. You notice exhaustion, those moments when price still moves, but conviction is gone. And that is important because markets often reverse not when movement stops, but when behavior changes. Cause leads to effect. Weak behavior leads to failed continuation. Failed continuation leads to trapped traders. Trapped traders create forced exits. Forced exits fuel momentum in the opposite direction. Everything connects. Once you understand this, you stop asking simple questions like, is it going up or down? You start asking better questions. Who is in control? Who is vulnerable? What pressure is building? What emotion is driving this move? That shift changes how you trade. You become less reactive, more selective, less impressed by noise, more focused on structure, less drawn to flashy candles, more interested in what price is quietly revealing underneath. Because candles show movement, behavior shows truth. Most traders enter the market believing their first goal is to make money. It is not. Their first goal is to stay in the game long enough to understand how money is actually made. That sounds simple, yet this is where most fail. They approach trading like a sprint, when in reality it is a test of endurance, judgment, and control. They think one big trade can change everything. They believe aggressive risk is courage. They confuse speed with progress. But the market punishes that thinking quickly. Ask yourself, what good is skill if your capital disappears before that skill has time to develop? That is the quiet truth many never learn. Survival is the first edge. Before profit comes preservation. Before confidence comes control. Before growth comes staying power. Because trading is not won by the person who takes the biggest risk. It is won by the person who remains clear headed through enough market cycles to develop real understanding. A trader who survives losses learns patterns. A trader who survives mistakes gains perspective. A trader who survives emotional periods begins building discipline. But a trader who destroys his capital early learns nothing except regret. Cause creates effect. Large risk creates emotional pressure. Emotional pressure creates poor decisions. Poor decisions create larger losses. Larger losses create desperation. Desperation destroys judgment. And once judgment is gone, capital usually follows. This is why survival is not defensive thinking. It is strategic thinking. Protecting capital protects opportunity. Every dollar kept alive is another chance to apply what you've learned. Another chance to refine execution. Another chance to observe market behavior with a clearer eye. Another chance to let experience become wisdom instead of pain. Most traders underestimate how much pressure money creates on the mind. A position too large changes everything. Your thoughts become louder. Your emotions become sharper. Small fluctuations feel personal. You stop reading price objectively and start watching profit and loss emotionally. Fear enters your decisions. Hope begins replacing logic. You hold losers too long because accepting loss feels painful. You exit winners too early because losing open profit feels threatening. Now ask, how can clear judgment exist under that kind of pressure? It cannot. That is why controlled size matters. Small risk keeps the mind calm. A calm mind sees clearly. Clear thinking produces better decisions. Better decisions create consistency. Consistency creates survival, and survival creates edge. Again, cause and effect. The market rewards those who last, not those who rush. Look at experienced traders, and you will notice something unusual. They are rarely obsessed with catching every move. They are not desperate for action. They do not treat every day like a battlefield that must be conquered. They know opportunity repeats. They know market cycle. They know preserving strength is often more important than forcing performance. That understanding creates patience. Patience creates selectivity. Selectivity improves quality. Quality lowers unnecessary risk, and lower risk extends survival. This is how real skill is built, quietly, over time, under control. Survival also teaches humility. The market is bigger than your opinion. It does not care how confident you feel. It does not reward stubbornness. It does not bend because you want a trade to work. Survival requires accepting this truth early. It teaches you to respect uncertainty, define risk, and remain flexible when behavior changes. That respect keeps you alive, and staying alive long enough to think clearly, adapt wisely, and preserve capital through difficult periods is what allows a trader to eventually discover that survival was never just about avoiding loss. It was about building the foundation that makes lasting profit possible. Most traders believe losses come from bad setups. Often, they come from bad emotions. That is what makes trading difficult to understand. The chart may look simple, the setup may look clear, and the plan may feel solid. But the moment money is involved, emotion quietly enters the room. It changes perception. It changes timing. It changes behavior. And most traders do not realize how much they are paying for emotional decisions until the damage is already done. Ask yourself honestly, how many trades were actually planned? And how many were simply reactions disguised as decisions? That question reveals the hidden cost. Emotion makes expensive mistakes look reasonable. Fear exits strong trades too early. Greed keeps weak trades open too long. Hope convinces traders that a losing position will somehow recover. Pride refuses to accept small losses, turning manageable mistakes into painful ones. Frustration seeks revenge after loss, pushing traders into impulsive entries they would never normally take. Every emotion carries a price, and that price is rarely small. Fear costs opportunity, greed costs discipline, hope costs clarity, pride costs capital, anger costs judgment, because becomes effect. A trader enters emotionally. Emotional entry creates weak timing. Weak timing creates stress. Stress makes every market move feel amplified. That pressure creates rushed decisions. Rushed decisions lead to mistakes. Mistakes create losses. Losses intensify emotion. Then the cycle feeds itself. This is why many traders lose the same way repeatedly, even when their strategy changes. They think the method is broken, but the real problem is emotional behavior attached to execution. The strategy changes. The emotional habits remain, and so the outcome repeats. The market has a strange way of exposing what lives inside a trader. If impatience lives there, trading reveals it. If fear lives there, price movement brings it forward. If ego controls decisions, losses quickly become personal battles instead of business decisions. The market reflects internal weakness with brutal honesty. That is why emotional control is not optional. It is part of the craft. A calm trader sees what others miss. He notices when excitement is crowd-driven. He sees panic where others see collapse. He recognizes false urgency. He understands that strong emotion in the crowd often creates distorted price behavior, and distorted behavior creates opportunity for those who remain clear. But clarity only exists when emotion is managed. How do you manage it? You define risk before entry. You reduce size when your thinking feels unstable. You step away after emotional losses. You stop watching every tick once a trade is planned. You follow structure, not feeling. Most importantly, you learn to separate self-worth from trading outcomes. A losing trade is not failure. A disciplined loss is part of business. But emotional trading turns every outcome into identity, and identity-based decisions are dangerous because they seek validation, not truth. Notice what happens when traders desperately need to be right. They ignore warning signs. They defend weak positions. They add risk to avoid admitting error. They turn simple trades into emotional battles, and battles against the market are always costly. The strongest traders are not emotionless. They simply do not obey emotion. They feel fear, but they respect structure. They feel greed, but they remain disciplined. They feel frustration, but they do not react blindly. That control keeps their decisions clean, because emotion is always present. The real cost comes when it starts making decisions for you. Most traders are aggressive at the wrong time. That is why they lose. They become bold when conditions are unclear, reckless when markets are noisy, and oversized when emotion is strongest. They attack uncertainty with confidence they have not earned. They risk heavily on weak conviction. They confuse aggression with skill, as though force alone can bend probability in their favor. But markets do not reward blind force. They reward precision. Now ask yourself, when do most traders feel most confident? Usually after a strong move has already happened, after price has surged, after momentum becomes obvious, after excitement spreads everywhere. That is when emotion disguises itself as certainty. Traders feel late, so they chase harder. They size bigger. They justify weaker entries because momentum looks undeniable. Then reality arrives. Price pulls back, momentum slows, weak hands panic, late buyers become trapped. Aggression becomes regret, because leads to effect. Poor timing creates pressure. Pressure creates emotional thinking. Emotional thinking creates poor exits. Poor exits create unnecessary losses. The problem was never aggression itself. The problem was when it was used. Selective aggression is different. It waits. It studies. It remains quiet while others rush. Then, when price behavior becomes clear, when structure tightens, when pressure builds, when momentum aligns with strong volume, when risk can be clearly defined, it acts with conviction. Not hesitation, not fear, not greed. Conviction built on evidence. That is the difference. A skilled trader may sit patiently for hours, even days, doing almost nothing. To outsiders, it looks passive. To the undisciplined mind, it looks like missed opportunity. But beneath that stillness is observation. Beneath that patience is preparation. He is watching behavior unfold, waiting for the market to reveal its hand. And when it does, he becomes aggressive. But only where the edge is strongest. Why waste energy swinging at shadows when clear opportunity eventually appears? This is where most traders fail to understand risk. They think selective aggression means simply taking bigger positions. It does not. It means increasing commitment only when probability improves and uncertainty shrinks. It means pressing advantage when evidence supports action. Not when emotion demands movement. That requires restraint first. Restraint creates clarity. Clarity improves timing. Better timing lowers pressure. Lower pressure allows decisive execution. Decisive execution captures opportunity. Again, cause and effect. Everything begins with waiting. Selective aggression also means knowing when not to fight. There are markets filled with noise, false breakouts, random volatility, and directionless movement. In these conditions, aggression is expensive. The market offers confusion, and confusion punishes force. A disciplined trader sees this and reduces exposure. He protects energy, he preserves capital, he waits for cleaner conditions. That waiting is strength, then conditions change, structure becomes clearer. Buyers defend levels repeatedly. Volume begins expanding naturally. Momentum builds without emotional spikes.